computer. So. Okay, a very good afternoon to the class and a warm welcome. So we continue from our class yesterday. Again, I look at a few tax concepts. I'll summarize them here. So the other time I've given a summary of a number of things we'll cover, but I think we stopped short of finishing everything, but it's okay. It's like I give some bite, which we should finish, but even if we don't finish, that's still okay. So today, I'll start by looking at the principles of taxation. So this is PFT, and we are looking at taxation. So those of you who are in the first class, remember, I said for a few weeks, we will only do taxation, and then down the line, I'll introduce public finance. Down the line, I'm going to introduce public finance because this topic, the unit is public finance and taxation, so I'll do that. So I already sent you the notes in case you didn't see, kindly check on your WhatsApp, you'll find the soft copy notes, but there's no harm you taking some short notation as we proceed. And then I also said something else, even as you read ahead, you must be aware that the rates that are available in the notes that I've sent some could be outdated because the work was last done in 2018. But as we proceed, I'll be giving you the current rates or current numbers. Like if you recall our discussion on the purposes of taxation, the numbers I gave you will not find in the notes. You'll find different numbers. For example, the maximum or set limit for contribution to pension, the allowable deduction, if you remember, is 20,000 per month or 240. I gave you that. Then contribution to registered home ownership savings plan, the maximum is 8,000 shillings per month or 96,000 shillings per annum. Those are current rates. And then for mortgage relief, those who are able to get a loan from the bank to buy property, which is called a mortgage. You buy on an occupied property and you'll be paying interest to the bank called mortgage. Again, we said it's allowable as a deduction, but the set limit is currently 25,000 a month or 300,000 shillings per annum. And so on. So if you look at the book, you're going to find different figures, but the theory or the content is the same. So kindly note that so that even if you're reading, there's no confusion. The content will just be the same. But I'll be giving you rates as we go along, the current rates, which you'll use in your current exams. All right. So we did purposes of taxation. I think we finished that. So today, I will say we are going to look at principles of taxation. I think we are likely to finish this. There are 9 principles. We're going to talk about those. We're going to talk about those principles. And then when we finish that, I might introduce something about classification of taxes. Again, here there are 3 classifications. I don't think we can go more than that. If we go more than that, I'll include something else. But okay, let me just include something else, just in case we're able to finish. But I doubt if you're going to go beyond that training. I think I can put one more thing, though I don't think we're going to finish this, but we might reach something called tax shifting. The concept of tax shifting. How do you shift tax? So having given this summary, So this is the objective today. We intend to cover that. So I'll start with the principle of transition. I think for those who are there in the first class on Friday, we discussed this a bit. I mentioned some principles like principle of equity, and I had indicated this principle was first proposed or introduced by an economist called Adam Smith. And equity is very, very important. Equity is about justice, about fairness, about equality. And he explained it in one sentence. He said, persons should not pay the same amount of tax. A person should pay tax according to his ability and not the same amount. So he summarized it in a sentence and say, a person should pay tax according to his ability. According to his ability. And not the same amount. In other words, those who have a higher ability to pay more should pay more. That's where the fairness comes. Those who have lower incomes are okay to pay less. So people should not be made to pay the same amount. Right? And that brings us to the progressive rates. So progressive rates operate like this. So this is what we'll be using in employment income. It's a staircase. The first rate is 10%. 10%, then you go to 20%, then 25%, then 30%. The last rate is 32.5%. For those with employment income in excess of 800,000 shillings per month, progressive rates. Now, progressive rates, this is what we call progressive rates. The rates of tax increase as income increases. This is one way. In fact, globally, many countries of the world use progressive rates in an attempt to achieve equity, to achieve fairness, so that the more income you have, the higher the marginal rate of tax. So essentially, you contribute more to taxation than those who earn less. So those higher up will pay more tax. You could say that's one way of achieving equity. Another way, especially what I see in Kenya, there's a minimum taxable amount. The minimum taxable amount currently is 24,000 shillings per month. 24,000. Let's say employment income. Employment income below 24,000 shillings per month. Any employment income up to below 24,000 shillings per month is not subject to taxation. So if you have employees and they're all earning less than 24,000, you do not need to institute the pay system. So the pay system in this country only works for employees who are paid more than from 24,000 upwards. So if you're asked to explain equity, especially for Kenya, first, we use progressive rates, which are used globally. And the steeper, if the rise in rates is very steep, then that's the way it becomes more fair, because those with higher incomes are impacted more, So the impact on the richer people of society is greater than the impact on those with lower incomes. Now, having said that, would we say that all incomes are equitable? Now that you've understood the concept, it's up to you to look at different taxes and see whether they pass this test of equality. Are they all fair? The answer is no. I can give you an example. An example is VAT. VAT is not progressive. VAT is at the rate of 16% for everybody. So you could say VAT is the opposite of progressive. It is regressive. Regressive in the sense that those who are poorer will carry a bigger burden. They'll carry a heavier burden than those who are rich, because if your MCA will buy goods in the supermarket, they'll pay VAT at 16%. It's included in the price. A lot of us might not even know that we are paying VAT. Now, your MP will pay the same VAT as you, yet your MP has probably his ability to pay is higher because his income is higher. Same to your MCA, same to some of the top business people, influencers and everybody else will pay VAT at the same rate. So you can use that argument. To evaluate any tax that is levied by the government. So that's the principle of equity. Now, those of you who are in the previous class remember that principle. Now, Adam Smith did not just have equity, he had other principles, like the other principle was principle of certainty. So principle of certainty. Principle of certainty. Now, certainty refers to predictability. Predictability. So if you're a business person, you plan, and you want to make forecasts the next 1 year, the next 2 years, based on the prevailing environment. Taxes, costs, rent, and so on. Business people make long-term plans. So principle of certainty is about planning by both the government and the taxpayer. Let's start with the taxpayer. So the taxpayer has to be certain about which taxes they are going to pay in order to plan. They have to be certain about things like dates. So if you're in business, I'm sure you'll have to be aware that if you are being registered for VAT, you must pay VAT by the 20th day. That's certainty. If you have employed workers and you are deducting income tax from their salaries, the amount deducted must be submitted to KRA by the 9th day of the following month. Now, that is certainty. There is another step we've gone to in this country. The Treasury has prepared a document called tax policy. So the tax policy, probably you could Google the tax policy, even if you don't read it, you might get an idea. Why we have to come up with a tax policy is because of this principle of certainty. You want to make the business environment predictable. You don't want to ambush people. So in a tax policy, the government will indicate, for example, when they will adjust taxes for inflation. In the past, people never used to know. When unaenda kwa iTax, you want to pay, then it fails to go through, simply because KRA has already adjusted the rate upwards. For example, you thought your excise duty was, say, 15% or 18%, yet KRA has already adjusted the platform in iTax, your excise duty upwards to 20%. So if you try to key in an amount of 18%, it refuses to clear you. It doesn't clear you. So it's later you try to make calls, probably you send somebody to visit KRA, and they tell you, you didn't know. We made a revision because of inflation. I'm sure you know what inflation means. Inflation simply means money has lost value because now, for example, if last year I was buying milk and bread at, say, milk, bread, and 2 eggs at 100 shillings, probably this year I have to pay 120. The difference is caused by inflation because I'm still buying the same loaf of bread, the same milk, but the same 2 eggs. But instead of paying 100 bob, now I have to add 20 shillings on top. Now that difference is caused by inflation. So inflation is the rising in price levels of goods and services. Now the rising in prices could be caused by 2 things. Either the increase in costs, the cost of production is going up, like producers have to pay more salaries, they have to pay more for fuel, they have to pay more for other costs, rent and so on. Then they increase their prices, you know. The other cause of inflation is when there's too much money in circulation. So too much money in circulation puts pressure on prices again to increase. But now, certainty here means for both the government and businesses, you have to have a predictable environment. So you cannot have an environment where you're ambushed. Yeah, you suddenly there's this tax, there's the other one, and they were not there earlier. New taxes are being introduced every other day. Then the business environment becomes uncertain. And then also about dates. So Adam Smith, the one who first proposed this principle, had argued and said, if there is uncertainty in the business environment, it's likely to lead to corruption. There'll be a lot of corruption. How so? Because the more uncertain the taxpayers are, the more you'll be pushed by officers from KRA. They'll tell you, didn't know you are supposed to pay tax at a higher rate. You're already late, you know, uncertainty. Then they tell you, if I take you forward now, you're going to pay this much. Why don't you give me half that amount or a quarter that amount? We settle this without going. So Adam Smith argued, if you don't make matters very clear in taxation, you will cause uncertainty, the opposite of certainty. And that is not good for any tax system. So certainty is the principle that guides planning. And planning here should be by the taxpayer and also the government. Let me explain how certainty will help the government. So the government also needs revenue collected from taxpayers. Now, if you didn't know, when they read the budget to pass a finance act, our finance bill for 2024-2025 was discarded because the courts not only declared it unconstitutional, but demonstration by Gen Z, you know, put pressure on the government to withdraw. So we are still using the provisions of 2023, 2024. So the provisions of 2025, 2024, 2025 did not see the light of day because of protests. People protested and the government set aside the finance bill. But there's no vacuum because we're still using the previous year's finance bill. It's only that probably the government had targeted more revenue by introducing new taxes, you know. Now, those taxes did not see. So when the government is preparing a finance bill, certainty means some of the taxes they put in a new finance bill, nobody knows how much revenue they'll bring, like motor vehicle tax, turnover tax. Nobody knows how much revenue they'll bring, but the government plans ahead and say, we are hoping VAT will bring 2 billion. We are hoping income tax will bring 3 billion. We are hoping corporation tax will raise probably 10 billion. So that in total, we are expecting a tax collection from KRA of 2.76 trillion. That was, at least that was the target they'd been given. And now they have to scale it downwards because some of the taxes that had been factored in did not take place. That's what certainty means. Planning. You cannot plan when the environment is uncertain. So this is equity. All taxes need to be fair to the taxpayer. They need to be just in the sense of how much you're supposed to pay. You should not be given a burden which you cannot carry. You know, I don't know. The court had declared that the affordable housing tax, it's 1.5% of your basic salary. They have declared it to be unconstitutional, but the government continues to deduct that from the salaries of those who are in employment. But clearly, but that's my opinion. Don't go and quote me, but even if you quote me, it's okay. My opinion is the housing levy is not equitable. Why? Only those who can be caught in employment pay. The rest of Kenyans, who are the majority, don't pay housing levy. And that's what the court had argued, that this levy is only targeting those in employment. Because if it's going to be equitable, then it has to target everybody. So the court had asked questions. How will the government make sure that Mama Mboga, Boda Boda, those who are in the Gikomba market pay affordable housing? The government has no framework. The government has no idea. So it fails this test. So affordable housing will fail the test of equity. It's not equitable. Now, Adam Smith had another principle. The other principle Adam Smith had was called the principle of convenience. Principle of convenience. He had a principle called principle of convenience. Just as the word indicates, Adam Smith explained that the tax system should be convenient to the taxpayer. In other words, it should not be a big task if a taxpayer is willing to pay. You know, if you want to pay, it should not be so difficult for you, yet you're the one paying the government. It should be as easy as possible. I'll give you examples of taxes that are very convenient. Those of us in employment, you know that the employer will give you net pay after deducting tax. That's convenient. How so? If you're given your gross salary and you're told, please pass by KRA on your way and pay your taxes before you can keep the net, the majority of people may not pass by KRA. So it's very conveniently deducted at source by the employer and passed on to KRA. That's very convenient. Also, VAT could be very, very convenient. Why? VAT is included in the prices of commodities. So the majority of Kenyans, unless you guys now go out and educate some of your relatives, they are not even aware they're paying. They don't know if they buy toothpaste, they're already paying VAT included. They only need to look at their receipt from the supermarket. They'll see the VAT amount paid and the actual price of the commodity without VAT. So there are some goods that are not subject to VAT, like bread. You'll see it will be indicated 0. There'll be no VAT collected and so on. So some taxes are very convenient because they are levied at the point which is most convenient. Income tax on employment income is levied at the end of the month. The end of the month is when people earn their salaries. So it's convenient for them. So that's when they are ready to pay. VAT is charged when people are shopping. Now you cannot go out shopping if you don't have money. So that's the appropriate time. When you're buying, unamalizana na tax. and so on. But not all taxes are convenient. But Adam Smith argued that if you want taxpayers to, to comply willingly, voluntarily, it's easier when you're dealing with people who are complying voluntarily, then make the tax convenient. Make it very convenient to pay. Don't make it difficult. There are some taxes that are actually difficult to pay. Let me give you an example. An example is a tax called capital gains tax. It's called CGT. So CGT is a tax paid when you sell a plot, land, or a building. Later on, we'll discuss CGT as a topic, but there's no harm mentioning them at this point. So if you're a seller of that, you must file returns. You must collect your money from the one who is buying property from you, then do calculations about your gain. Not everybody knows how to calculate what they've gained from land. You have to get the transfer value, and then you have to get something called the adjusted cost. Then the transfer value, you subtract the cost. The transfer value is simply the amount you obtain out of selling land or out of selling buildings. So what I obtain, I subtract the cost I incurred, like advertising, or say maybe you paid some commission to some brokers, to some agents, you lessen that. Then you get your transfer value. The adjusted cost is the cost you initially paid when you're buying the building or you're buying the land. So transfer value, if you know how to calculate transfer value, then minus or less adjusted cost. We'll give you what we call the net gain. Then CGT, capital gains tax, will be at 15% of that net gain. These computations are easier said than done, because if you are an owner of property, owner of land, owner of a building in town, you have to have kept records every year of every cost you have incurred and all the expenses you had incurred when selling the building. So that you do this calculation, you have to employ an accountant. Then it might take years before you decide to sell a building or a plot. Then you have to understand these computations before you calculate capital gains tax. Then you file returns with KRA. Now, if all this is something you can't do, and you have to hire somebody and pay probably a percentage of the transfer value, then it is inconvenient. So if I'm selling my building or my property, and some buildings in town are very expensive, and I have to pay a broker some money, then that is very inconvenient. Or I have to look for somebody to prepare these accounts for me, then that is very, very inconvenient. Then Adam Smith had yet another principle. He had four. It's called the principle of economy. So the principle of economy argues that if a tax is not economical, discard it, abolish it. And there are taxes that have been abolished because they were not economical. So the economy is in terms of being economical to the taxpayer and being economical also to the government. So those two, like the government, should not administer any taxes that are more expensive to administer than the revenue expected to be collected. Some taxes may be too expensive to administer. We used to have a tax until 1990. There was a tax called sales tax. Sales tax was abolished and replaced with VAT. Why? VAT is wider. VAT is charged on both goods and services. Okay, so VAT brings more revenue to the government. And VAT, the cost of running VAT is borne by the trader. It is due to install e-teams, it is due to install computers, it is due to do everything. KRA will only send auditors to audit. Some of you who are accountants in your places of work already know this, that to account for VAT, you have to, you're the one that has to put in place an accounting system. You have to have electronic tax information management systems, or e-teams. You have to have computers. You have to employ accountants to keep records for you. Then you have to file returns within 20 days of every month. So VAT is very expensive for the taxpayer, but not for KRA. Income tax, again, the records are kept by the employer, not KRA. KRA only waits for a check, and so on. In that sense, those taxes are very economical to the government to run. So income tax is here to stay. It will not be abolished. Same to VAT, because the weight of managing VAT is with the trader, the supplier, the producer. It is them to keep records and file directly with KRA in e-team. So KRA will only monitor. I mean, all invoices that have been sent. So when you're claiming your VAT payable, they check whether it can, the e-team's system can reconcile what you're claiming as input tax. Is it also in their register? And so on, to avoid tax evasion. So economy looks at both sides. Economy looks at the taxpayer. The taxes should not be too heavy. I want to believe part of the reasons the Gen Zs were going to the streets earlier this year, and they made it very difficult for the government. They were arguing on behalf of the majority who may not be able even to go to the street. They were arguing about legit things like the cost of living. Some things that might push up the cost of living could be taxes like VAT on fuel and fuel cuts across the board. They were arguing about things like corruption, and so on and so forth. So part of the main argument of Gen Zs, and that's why they got support across the board, was that taxes were too heavy. And there was no accountability and openness. These revenues were being collected, but as the young people were putting across, the use of the revenues was not transparent, was not accountable. There was a lot of waste and corruption and misuse of public funds. And the government could not argue against those because they were factual and so on. So in the same way, you can evaluate some taxes and say, is it too heavy on the taxpayer? Is the taxpayer carrying a very heavy burden? So when you argue in that light, you're talking about economy. So the government should also watch out. Don't put a system that is very difficult to administer and expensive for the government. So any taxes that are proved to be difficult to implement should be abolished very fast, so that the government only implements taxes that are easier in terms of cost, they're cost effective, and they yield sufficient revenue. So these were the 4 principles according to Adam Smith. Like I told you, you'll find these arguments very, very good, because they are the same arguments you can also use to argue against a tax system. If you're told, what are the disadvantages of income tax? Think in terms of this. What are the disadvantages of VAT? Think in terms of the principles of taxation. So if the principles of taxation are against some of those taxes, then it means they're not optimal. It means the taxes are not as good. Now, this was by Adam Smith. Now I want to introduce another 5 principles that were proposed subsequently by other economists that came after Adam Smith, who lived around 1778, you know. So the other economists, learning did not stop. So they came up with other principles, which I want to list here. So there are an additional 5 principles, like principle of elasticity, principle of productivity, principle of flexibility, principle of capacity. There's one more. Elasticity, flexibility. Which canon am I missing? There's one more principle. Let me just see what is missing. That's the diversity. Yeah, simplicity. Sorry. I missed one more. Principle of simplicity. So let me discuss each one of them. I'll start with the principle of the last one here, principle of simplicity. So other economists agreed with Adam Smith. Equality is good, equity is good, certainty is good, convenience is good, economy is good, but we could make it better. Okay, we could make it better. Suppose the whole system was very simple, to be understood by the ones who are paying that tax. It would even be excellent, you know. It would be super if the taxpayer does not need an expert. He himself can argue. But if you notice in this country, though we've moved quite a bit, a lot of people still think tax is for professionals, is a specialized area, which should not be the case. It should be simple to be understood. In other words, if you wanted to calculate your own tax from your employment, you should be able to do that without having to seek help from anybody else. There are some taxes that were introduced because of simplicity. A tax like turnover tax. Turnover tax, as the name suggests, is the tax that is charged on sales, on the turnover. There have been arguments against this tax. Traders argued correctly and say, look, this is not fair. Why isn't it fair? Because for those who are in the first lesson, we talked about characteristics of a tax. And we said a tax will only be levied where there's an income. Now, when you tax turnover, you're not taxing income. You're taxing the gross sales. The rate of turnover tax is 1% of sales, but I've not deducted my costs. You know, I've not deducted my expenditure. But the government is arguing that this tax is for small businesses, like, you know, small and medium enterprises, what we call in this country SMEs. Why? They're saying SMEs don't need complicated records. They're telling SMEs, just give us 1% of your sales. Okay, it might sound simple. Everybody might understand it. Everybody could be able to calculate it. But is it fair? It may not be. Because at the end of the day, the business might have a loss. yet you've already made them to pay tax. So it goes against the very foundation, the very foundational concept of what a tax is. A tax is supposed to be charged on your increase, your gain. But this one is a tax on your sales. But it is there. The government is imposing it. But if you're asked about a simple tax, this is one of them. Because the government says you don't need records. You don't need complicated equipment. Just give us 1% of your sales. Then you pay quarterly, every 3 months. That's how turnover tax works. The only downside, disadvantages of this tax is that it's unfair. It's not equitable. You know, it's not fair because tax is supposed to be based on income. This one is based on gross sales. You've not deducted your expenses, yet you're being asked to pay tax. At the end of the day, a business could still report losses, yet they've been made to pay 1% every 3 months of their business for the whole year. So they pay turnover tax, yet they have losses. There are many businesses. Actually, I saw on social media a young Kenyan who is running a business. Can I remember what business he was running? KRA called him, all right? Sometimes KRA can get you through your email address or any other contact position. KRA called him because they were demanding given high amount of tax. Actually, KRA can call you for an interview on the slimmest of reasons. For example, if KRA advertises online for training, free training on VAT, excise duty, stamp duty, which is a good job because it's one way of enhancing awareness about taxes of the citizens. But the moment you attend those training, they immediately follow you with an email asking you questions about your experience with filing VAT because they want to follow you and see whether you're working for a business, where is the business, do you file returns, and so on. Now, if they do that, a lot of people will shy away from booking or from registering from their training online, because once you register and they get your contacts, then they start following you around and asking you questions about tax compliance. So I was talking about simplicity. The tax should be simple and easy to understand. In other words, an ordinary trader, an ordinary Kenyan should not have to hire a professional to explain to them and to help them calculate their taxes. That's what simplicity is about. So we are not there yet, but I believe going forward, tax system will be made simpler and simpler in order to be understood by the ordinary taxpayer. So the more a tax is simplified, the more compliance, voluntary compliance is achieved. Let me give you another example of simplicity in tax system. We have a monthly rental income, or let me call it residential property. Rental income. Rental income on residential property. So residential property means you have property, you're a landlord, but your property is not commercial. You don't own shopping malls. Those are commercial buildings. Offices in town, those are commercial buildings. Supermarkets, those are commercial buildings. Godowns or warehouses, storage facilities. Those, I'm not talking of commercial buildings. I'm talking of residential property where families have rented property and live there. What the government has done to make it simple for landlords to comply They say a landlord can pay to KRA under what we call monthly rental income tax. It's called MRI tax regime. They can give to KRA every month 7.5% of the gross rent. So the government is saying, if you're a landlord, don't worry about records. Just give us 7.5% of what you've collected as rent. So if you've collected 100,000, then it means you're going to pay something like 7.5% will be something like 7,500. If your rent is 100,000, which you've collected from your properties, then you file returns every month. It's as simple as that. They tell you, you don't need records about your expenses, you don't need the P&L account, just give us 7.5% every month and you're good. It's towards simplicity. They want as many landlords as possible to come inside the tax bracket so that KRA can achieve their revenue targets without having to leave out anybody. So you can see how important these principles are. The principle of simplicity. You can also look around. Now that you work in an office and you look at social media, look around and try to evaluate other taxes and see whether you can see an element of simplicity. Simplicity is simply removing anything that is complex, that is difficult to work with. And I'm not saying our system is perfect. Some of you work every day and know some taxes that could pose difficulties. It means they've not arrived at simplicity. But there are those that have been simplified, but not everything has been done. So that's the principle of simplicity. Then you have the principle of elasticity. Principle of elasticity. So elasticity means the tax system should be responsive to change in the economic environment. Responsive in the sense it should be possible for the rates of tax to increase or to reduce. Now, we are all citizens in this country, and we know there's a lot of elasticity in our tax system because the rates keep changing. The current rate of VAT is 16%. The current CS at the National Treasury, who has just assumed office like a few months ago, is already proposing in the new finance bill, which will be 2024-2025, they're already proposing a VAT rate of 14% and corporation tax rate of 25% instead of that. Currently is that, to reduce to 30%. And research and a lot of professional opinion is of the view you can collect more taxes when you keep the rates low. Why? Because there'll be more consumption. People will not limit their consumption. So you can collect more by putting the figures down. So if that is the principle, or if that is the concept, then probably the government will be going the right direction by lowering rates of taxes so that you ensure you get more people in the tax net. That way you collect more revenue than asking for very high rates and very few people paying. Now, those of you who remember what happened in 2020, the year was 2020, during COVID, when there was a lot of uncertainty about the future, there was no vaccine in sight, people feared for their lives, and a lot of jobs closed. And people were working. That's where the idea of working from home started. Now, because there was an economic downturn, because of the challenges that resulted from that time, the government had to reduce rates. The rate of VAT was reduced to 14%. VAT was reduced to 14% at the time. Corporation tax was reduced to 25%. And that is what elasticity is about. It means the government should be able to increase or decrease rates of taxes according to the revenue requirements of the country or of the state. If the revenue requirements change, it should be possible either to increase or decrease. I talked about excise duty. Excise duty is a tax on manufacturing. And I must have mentioned when we were doing purposes of taxation in the other lesson on Friday, I said every year the government raises excise duty on whiskey, on beer, on cigarettes. Why? Because it is very, very intentional. The main objective is to raise revenue, yes, but the other objective is to make these goods expensive and out of reach by the majority, by some of the Kenyans. Or at least if the government can force you to reduce your consumption so that you don't take too much, it can be hard on your pocket because every time they increase excise duty on that is elasticity. So keep watching. Every year when the government reads its budget, you'll see an increase in excise duty. Especially, they call it a sin tax, especially on production of beer, production of cigarettes, importation of wines, whiskeys, and spirits. And you'll never see the consumers demonstrating in the streets. You'll never see a demonstration for smokers in the street. You'll never see a demonstration for those who take beer, because these are goods that are addictive. These guys feel compelled. They must take them, regardless of the price. And the government says, okay, you can import whiskey, but you'll pay excise duty, higher excise duty, dumping tax, and VAT. So the government collects revenue from them. It's a better approach than simply saying, close that business. There'll be hue and cry. Kenyans will say, we are losing jobs, investors will say, you're destroying the investment climate. So the better way to approach it is increase taxes every year. Add on to taxes. So that's the principle of elasticity. Now, do we have any question up to that point? Any question? Anyone with a question? And you can read more in the notes. Don't forget, I've sent you those notes. So what I'm explaining is what you already have. So at your free time, go through the notes and read. But you can take down any little thing you want to take note of. So that's elasticity. Now let me put now the principle of flexibility. The principle of flexibility. So flexibility means it refers to the law that is used to impose taxes. For example, we have income tax act, we have VAT act, we have excise duty act, this one is an act of 2015. VAT Act is also Act of 2015, 2013 or 2015, 2013. We have Customs Management Act, or just Customs Act. So flexibility points out to these laws. Can we change them? Is it possible to amend? Is it possible to amend a section, just a section, or a provision? The government may be in need of just changing a section or just changing a provision. or abolishing a schedule altogether in any of these laws, it should be possible. So if any of the tax law cannot allow changes, then it is rigid. Rigidity is not good. If something is very rigid, it means it can break. It's important that something is flexible. It can be twisted this side, the other side, and you can point out examples of flexibility in the Income Tax Act, or in the VAT Act, or in the Customs, or in the Excise Duty Act. So Excise Duty Act, every time they change the rate, they have to change something in the law. The changes are done by Parliament, and Parliament has power to include an amendment. It has power to include, to abolish a section of any of these laws. So that's what flexibility means. Can legislators, can Parliament change any of this? Not the whole of it, because it would be very expensive to change the whole law. You just change one section to be able to meet the objectives of the government. So if that is possible, then there is flexibility. If it's not possible, then our law is very rigid. Rigidity is not good, because from time to time, you need that ability to change. So that's flexibility. Then I'll introduce principle of productivity. So productivity is about yield in tax revenue. So KRA is given targets every year by the government. So we must have taxes that bring sufficient revenue that will enable KRA to collect the revenue expected by the National Treasury. So this principle of productivity argues any tax that costs more in terms of administration and cannot collect sufficient revenue should be abolished, should be removed. And I can give you examples of taxes that were not productive in the past and they were removed. Like there was a tax called a gift tax. Then there was a tax called inheritance. These taxes are still there in the UK. So because we were a colony of the British, they introduced some of the taxes in their country here. And now, gift tax is not productive in a country like Kenya. I don't know how many, do we have a sizable number of citizens that get gifts of value, which can be taxed? Something of value is, like I saw on social media, I don't know the truth of this, but I just saw on Facebook that a guy, he calls himself Oga Obina. I don't know his true name. He gifted a lady I think he's been mentoring, called them on Facebook. You guys are better on social media. I think it is a week ago or a few days ago, he gifted her a car, a whole car. Now, if it was in England, Demo Facebook would have paid tax on that gift. But in Kenya, we don't have gift taxes. So if you get a gift from your grandfather, or you get an inheritance from whoever, then you're not taxed. But the reason why these taxes could not be productive is, how many people in Kenya receive a car gift? How many people in Kenya get an inheritance? I'm very grateful to my parents, but I think my inheritance was it's not just because that's what I use today to survive schooling, Some people get more, and we should all be grateful. Some people inherit buildings, some can inherit land, and it's a good thing. If God blesses you, work hard to leave an inheritance, to to your children, and you'll be an honorable man. But most parents, not their liking, I think every person is responsible and loves their children, but we end up leaving children little or nothing. But at least if you've been taken to school, you trust God, you know. So inheritance tax did not work in Kenya because it was not productive. Who gets an inheritance? So what are you going to tax? That's productivity. Then there was even a sales tax. Sales tax was abolished in 1990. It used to be there in Kenya. They abolished it and it was replaced by VAT. Why? VAT is better in terms of productivity. So VAT is levied on goods, on services, and even on imported goods and services. Sales tax was very narrow. It was only levied on manufactured goods peke yake. So even if there would be tax evasion, which is illegal, if some people don't pay, then the government would lose a lot of revenue. But VAT is better for purposes of collecting tax than sales tax by far. Number one, VAT is collected in stages. And at every stage you collect VAT. It's called a multi-stage tax. The supplier will collect VAT, probably sell his goods to the manufacturer, who must also charge VAT on manufactured goods. Manufactured goods are sold to the wholesaler, who again will collect VAT. The wholesaler sells the same goods to the retailer. The retailer also charges goods. So at every level, there is value addition. Value addition means you add on whatever cost you've incurred. So the cost is going higher. And on your selling price, you charge 16%. Now, those who collect VAT are not the payers. They collect it from their customers. So whoever you sell to are the ones paying, so you collect and remit to the government. So you only account for the VAT. So VAT is much better than sales tax. So some of these were abolished. They were not as productive. Then the last canon is called the principle of diversity. So diversity, if you will, means variety, means multiplicity, multiple taxes. And the argument is this. For a country, a modern economy like Kenya, you may not meet your revenue targets by only having a few taxes. Imagine for a minute if this country had only income tax on employment, for example. Now, those in formal employment is only a small percentage of Kenyans. The majority of Kenyans are either trading or in Juakali or other sectors, matatu and others. If there was only income tax, then the government would collect very little. They will not achieve the principle of equity. Equity means all Kenyans should contribute to tax according to their ability. It means if you have only two taxes or a few taxes, some will be left out. They'll not be able to contribute to tax. So that reason explains why you need to have several taxes for two reasons. It will ensure everybody is able to contribute. That is equity, according to their ability. And secondly, it will ensure the government collects sufficient revenue, yield of revenue. So if you look at it, Kenya has several taxes: VAT, customs duty, corporation tax, income tax, petroleum levy, stamp duty, excise duty. There are many. Capital gains tax, you know. So our country is a country of multiple taxes. So those are the principles of taxation. There are 9. So if the examiner theoretically asks you to evaluate a tax system and he tells you, normally gives a number, or if it tells you, gives you a direct question, say, can you explain the principles according to Adam Smith? The principles according to Adam Smith is equity, certainty, convenience, and economy, therefore. But if he says, can you explain any 4 principles? Then it means you can decide on any 4 among the 9 and you explain. So do we have any question on the principles of taxation? Anyone with a question? Very well. We move to the next topic. So the next concept we discuss, and this is very, very important, is how do we classify taxes? So classification of taxes. So if you want to group or to categorize taxes, or to classify them, then there are 3 ways you can do that. There are 3 aspects. So you can classify taxes by effects. You can classify taxes by tax base or by basis, or you can classify taxes by rates. So these 3 will put taxes in a particular group. Let's start by the first one, by effects. So if you want to know the effects of a tax, you can look at the effects in terms of incidence. Well, let me start with impact, then incidence. So the effect of any tax, whether it's stamp duty, corporation tax, VAT, excise duty, petroleum levy, capital gains tax, if you want to understand the effects of a tax, then you look at these 2 concepts, impact and incidence. So what is impact? Impact is the person who is held to account by KRA, the one who bears the responsibility for that tax, the one who must answer to KRA about this tax. That's where the impact is, the person on whom it is imposed. So the effect of any tax can be looked according to its impact, and the impact is on this person that bears responsibility for tax, the person who is answerable to KRA, the person who will provide accounts for that tax, the person who will even forward the payment. Just forwarding is where the impact is. So this is the person who bears. Person who bears responsibility. Responsibility for the tax. How about the incidence? This is where the money is paid. Where the money is paid. Where the burden of payment is. So any tax has 2 effects. It has an impact and it has an incidence. So how do the classifications come? Like this. So in this sense, if you look at the effects of a tax, you can have 2 classifications. You can have a direct tax, and you also can have an indirect tax. So all taxes can either be direct taxes or indirect taxes according to these effects, impact and incidence. Let's take an example, income tax. Income tax is a direct tax because both these two are on the same person. The person who is responsible for the tax is the same person who is going to pay income tax. Both the incidence and impact are on the same person. Income tax is the tax you pay on your salary. That tax cannot move. It is imposed on that salary. It will be accounted for on the basis of that salary. The payment is on the same salary. So both the incidence and the money burden is carried by the same person. So income tax is a direct tax. Both the incidence and the impact are on the same person. Corporation tax is a direct tax. It is imposed on companies. A corporate is a company, like Safaricom, like BAT, like EABL, East African Breweries Limited, or KBL, Kenya Breweries Limited, or any other company, or even banks, Equity Bank, they are corporates. They pay tax at the rate of 30%. The impact or the person it is imposed is on the corporate. The payment is on the same corporate. The tax cannot go anywhere. Those are direct taxes. So indirect taxes, impact and incidence are on the same person. E.g., income tax, corporation tax. How about an indirect tax? The impact, the responsibility is on person A, but the payment is on person B. Take VAT, for example. VAT will be accounted for by any registered supplier. It could be a lawyer providing legal services, a supermarket selling goods and services, but they don't pay VAT. They only include it in the price, so it's paid by their client, the customer, and so on. So VAT is an indirect tax. The impact and the incidence is not on the same person. VAT is imposed on the trader, the supplier, the producer, but he'll invoice his customer. So it is the customer who pays, then he collects the money and gives to KRA. The traders don't pay VAT. So VAT is an indirect tax. So the impact and incidence are on two different persons. E.g. VAT. So VAT is imposed on a producer, a supplier of services, but it is not paid by the producer or supplier of services. It is paid by the customer. So supermarket, kazi yao ni ku-account tu. They just account, but the VAT comes from their customers. So if you want to categorize taxes by effects, you'll have two types of taxes. You can have a category called direct taxes, like income tax, corporation tax, taxes that cannot be shifted. They cannot be transferred from person A to B, but indirect taxes can be transferred. If the government imposes excise duty on whiskey or cigarettes, on wines, what will the companies do? They'll increase the price to accommodate the tax, and the price will be paid by their customers. So the tax has shifted from the producer to the customer. So VAT is an indirect tax. So if you have the first classification by effects, you'll have direct taxes and indirect taxes. Any question? Any questions so far? Anyone with a question? So any tax you think about, if you look at the effects of a tax, if you look at where its impact is and the incidence is, then it can either be a direct tax or an indirect tax. Either the two. Those are very broad or very wide classifications. Then you can also classify taxes by basis. So what is a tax base? A tax base is the object, the target. What does the rate of tax target? So that will give the tax a name or the classification, you know? So here, base of a tax is the object. The object on which tax rate is applied. So you name taxes according to the object which is being taxed. For example, you can have income tax. So any tax called income tax is a classification of taxes where the subject of tax is the income. So here, the tax base is income. So the tax on employment is called income tax because the object is income. You could also have a classification like corporation tax. The tax base is the profits of a company. So all taxes paid by companies come under the classification of corporate taxes. Corporate taxes. Taxes paid by corporations, by companies. Another tax base would be expenditure taxes. An example of an expenditure tax, a tax that is based on how much you spend, is VAT. So VAT is an expenditure tax, e.g. VAT. Then you can also have property taxes. An example of a property tax is stamp duty. Stamp duty is a property tax. Capital gains tax. These are called property taxes because the basis is property. So classification by base, the name will tell you what will be subject to tax. There'll be a rate, but the rate will be applied on the tax base. So if they tell you these are corporate tax, what comes into your mind, these are taxes paid by companies because of the naming. So what will be taxed is the income by a company, not an individual. If it's income taxes, is incomes of individuals. They'll be subjected to certain taxes. So that's classification by object. You give taxes the name according to what is being taxed. You could have property taxes. So when you're selling land or you're selling buildings, then you pay stamp duty. If you are selling within urban areas like Nairobi is an urban center, Mombasa, Eldoret, if you're selling buildings within towns, then you give the government 4% of the value of the property. That's called stamp duty. If you're selling in the rural locations, they charge you half of that, 2% of the value of property, whether you're selling land or buildings. So stamp duty is called a property tax. Capital gains tax, which I explained earlier, where you pay tax on the net gains of property you've been having for some time, whether it's land, buildings, any property you've been having. Then you pay tax on the gain. Those are called property taxes. VAT is an expenditure tax. The more you spend, the more you pay. If you buy a whiskey going at 10,000 shillings a bottle, then 16% of that you must be ready to pay. If you buy soap and the soap is worth 200 shillings, then you pay 16% of that. So it's an expenditure tax. It's based on how much you spend. Okay, so that's the second classification. Now I want to move to the third classification, where we classify taxes according to rates. Now, do we have any question so far? Anyone with a question? So we go to the next classification by rates. So let's classify taxes by rates. So you can also categorize taxes according to the way the rates behave, starting with progressive, rates. You can also have degressive rates. You can also have regressive rates. And you can also have proportional rates. So let's see what are the differences. We start with progressive rates. So progressive rates increase as income increases. So they are very common globally. Most countries use them to achieve fairness, equality. As income increases, the rates of tax, the major rates of tax increase. Like I showed you the graduated scale rates. The rate of increase must be steep. So the current graduated scale starts from 10%, then goes to, I think, 25%, then goes to 30%, then goes to 32.5%. Progressive rates. The rates of tax increase, and the rate of increase is very steep. So it means they are heavier. They put a heavier burden on the rich than on the poor. Those who earn lower incomes will pay tax at lower rates. But those who are richer, higher up the scale, will pay more tax. That's progressive rates of tax. How about degressive? They are similar to progressive rates in that they are also increasing as rates of tax increase. The difference is this: the rate of increase is not steep. In other words, they increase but at a decreasing rate, slowly. So they burden the poor more. They don't increase very fast. So they are not as progressive as may be required. So they don't increase very fast. So if you drew a rate like that, it will not be steep. These are degressive rates. Degressive rates. The rate of increase is not as high. So it means even the government will not achieve its revenue objectives. What is collected, because you can't collect much from the poor. So these rates are very slow. So this graph is not steep. Degressive rates. Okay? They are similar to progressive rates in that the rates of tax increase as income increases, but the difference is this: the rate of increase is not as steep as that of progressive rates. The rate of increase is slower. You can say they increase, but at a decreasing rate. So these taxes are unfair, especially to lower income groups, because they don't rise as fast. So they don't reach higher income groups. They're a burden. to the taxes, to the lower income groups of the society. So it means, logically, the government can also not collect sufficient revenue. Those are digressive rates. Digressive rates. Now let me look at regressive. So the other rates we call regressive. So any rates of taxes that burden the poor more than the rich will be said to be regressive in nature. Any rates that don't discriminate between who is rich and who is poor. If we are made to say pay the same rate of tax as citizens, then it means there's somebody carrying a bigger burden. And that person is the one who has lower income, the poor. Then we call that those types of taxes regressive. VAT is an example. VAT is said to be regressive in nature. Why? Because it does not discriminate between the rich and poor. There's no rich rate for the poor. There's no rate for the rich. It is levied at 16% on all goods and services. So both the rich and the poor pay tax, VAT at the same rate. But don't forget, since the poor have lower incomes, the burden is heavier. They feel more burden than the rich. So you can say VAT is regressive in nature, because the tax has a heavier impact on the poor than on the rich. Then we have proportional rates. So a tax is called proportional if the rates of tax don't change. It remains the same. An example is corporation tax. Which currently is at 30%, regardless of the size of the company. Whether you're a large taxpayer like Safaricom, making profits of billions of shillings, the corporate tax rate remains proportional at 30%. If you are much smaller companies, small and medium companies, they pay tax at the same rate. So those are called proportional rates. So it means if you a graph like this, where your rates of tax, and this side probably your profits, the rate of tax will remain the same. It will not change, regardless of the level of profit. The rate of tax remains the same. So that's classification. Done. I don't know whether there's any question when you think about classification by basis, not basis by effects, where you have direct and indirect taxes. Then you have classification by basis of the object which is being subjected to tax. So you have income taxes, expenditure taxes, property taxes, those classifications, and even more. You could have import duties and so on. Then it will be under classification of taxes that are charged on imported goods and so on. All right. Then you can have a classification by rates, the behavior of rates of taxes. So the examiner can ask you, what are progressive rates? What are regressive rates? What are digressive rates? Or what are proportional rates? So that's classification. Any question? Any question? Then there is something we need to expound on just a little bit, And that was the concept of tax shifting. So for those of you, if you remember, when I was discussing indirect taxes, the distinguishing feature was the impact and the incidence of tax is not on the same person. The impact of the one who accounts for the tax is person A. The payment is on the customer, person B. So we can say that tax has been shifted from person A to person B. Even for excise duty, the government imposes increased excise duty on airtime. What does Safaricom do? And Airtel, they revise their tariffs for call rates or even for M-Pesa and so on. What they've done is they've transferred the tax burden to the consumer and so on. So that brings us to another concept we call tax shifting. The concept of tax shifting, especially for indirect taxes. So what does this concept mean? It simply means the transfer of the burden of tax from one person to another. That is tax shifting. So there are two ways tax can be shifted. There is what we call forward tax shifting. Forward tax shifting simply means the producer, the supplier, simply increases price so that it is the customer who pays more. If there's increased excise duty on beer and beer prices are revised upwards, then that is forward shifting of tax. But we can also have backward shifting of tax. Now, backward tax shifting. So backward tax shifting is a case where there's a tax that is imposed on the producer, but the producer cannot shift it to the customer. Why? Especially for commodities in a lot of competitive markets. So there are substitutes all over. So the producer is afraid of losing their market share. So the producer has to be very careful with their pricing. So there is this burden of tax. Where will they take it? They cannot take it to the consumer because they are afraid the consumer will simply shift to their substitute good, especially for commodities with substitutes. So what do? They negotiate with their suppliers. They try to negotiate with their suppliers to accept lower prices. Okay, so the supplier could be labor. So if labor can take a reduced rate, your employer tells you, our environment, our production environment has become difficult. So probably you can assist us by taking a price cut. Or if you are a processor of milk or of foods, you talk to the farmer and say, I may not be able to pay you the same price per liter of milk, the same price per each mango. So if they accept a lower price, then that is called backward shifting, where the tax burden is shifted backwards to the suppliers of factors of production, suppliers of materials, suppliers of labor, and so on. Okay, so we can have forward tax shifting, where, remember, tax is shifted by revising the price. So forward tax shifting means the price is revised upwards. Backward tax shifting means the burden of tax, partly the producer bears, partly it shifts backwards to the suppliers of factors of production. Now, for these two to happen, there must be certain factors that influence. You cannot just decide you're going to pass an increase of price to the customer. You as the producer must think. For example, for beer, it is possible. For wine, it is possible. For spirits, it's possible. And the reason is because of the first factor. The examiner can ask you about factors that influence tax shifting. What factors will influence tax shifting? The first factor is elasticities of demand and supply. So elasticity is the responsiveness in demand or supply as price changes. For example, for beer and cigarettes, the response is inelastic, meaning even if their prices increased, the change in demand for beer and cigarettes will be at a small percentage. You could have increased price by 20%, but the response could be less. Say the change in demand is by 10%. So overall, they collect more revenue and the government also gets its taxes. So for goods that have inelastic demand, so any commodity with inelastic demand, inelastic. E.g. beer, cigarettes, wines and spirits. For those goods, the producer will shift tax forward. And incidentally, think about it. There is no day you'll hear that people have been given discounts on cigarettes or beer or whiskey. There are no discounts. The price will always go up. Think about it. There is no day the price will be reduced so that you can buy. Why? They know that the demand is inelastic. There are few who might reduce their consumption or who might even stop consuming, but the percentage change will be smaller compared to the increase in demand. So increased taxes by the government are usually imposed on goods with inelastic demand, such as beer and cigarettes. But then there are other goods with elastic demand. Goods that have a lot of substitutes in the market, like toothpaste, soaps, and so on. The manufacturers of these goods are very careful because if a tax is, for example, if there's increased taxes in Colgate, for example, and the price of Colgate goes up, the producers of Colgate decides to increase price. What will people do? People will buy the other toothpastes, and that tax increase will fail. So for commodities with elastic demand, they'd rather negotiate backwards. In elastic demand, commodities with substitutes, like cooking oil, toothpaste, soaps, as long as they're substitute products, the producer is very careful. Even if there's increase in taxes, they'll shift the tax backward. How about supply? In case of inelastic supply means supply cannot change. Supply may not change in a case where the supply is producing perishable goods, like a farmer. A farmer may bring tomatoes, onions to the market, Now, if the supply is more, the price will fall, but he'll be forced to sell at that price. Like now I look around, and a very big tomato in Nairobi now, in the estates, goes at 5 million. Why? Because of increased supply. But there's nothing the farmers can do about it, because tomatoes are perishable. You cannot say, I'll keep them until the price is right. you cannot keep the goods. So they are elastic, that is inelastic supply. You cannot change the supply. So it's not possible to shift the tax, any tax to the consumer if the supply is inelastic, So that's elasticity. Another quick factor, I may not mention all of them because of time, but I think I'll start from this. Let me just stop there and say, I'll repeat again the concept of tax shifting. I'll start from there. The concept of tax shifting. Then I'll give you a list of other things I will do in the next class. I think in the next class, I'll do 2 or 3 things. Then I start taxation of employment income. So this is a bit of theory, which I'm introducing you to so that you can be reading. If you look at your past papers, they ask questions. What is tax shifting? Can you name 4 factors that influence tax shifting? So I'll be going through this theory the way I'm doing. So there are some areas I'll go through again next week before I introduce employment income. But you'll find this theory useful, especially when we start answering past paper questions, even employment. You'll find part A is asking you what are the principles of taxation according to Adam Smith? For example, what are the advantages of a direct tax? What are the disadvantages of an indirect tax? And advantages and disadvantages, you get them from the principles of taxation. That's how you get an advantage of a tax. Is it elastic? Is it productive? Is it simple to understand? Is it equitable? Is it certain? So advantages and disadvantages come from the principles of taxation. Can give you advantages of a direct tax and an indirect tax. Probably we'll be looking at those in questions. In questions. Okay. So you'll see this theory to be very, very important. It will help us to answer questions when we begin, especially to Kianza employment income, we'll be doing some questions. And when you look at a question, you'll find it as a part A, which has this theory, or a part B. So to answer the whole question, you have to rely on this. And so we'll stop there. So in the next class, I'll finish with tax shifting. Then I'll introduce the next concept. I think it's something to do with taxable capacity. I think there are only 2 areas left, taxable capacity and something to do with fiscal policy and budgetary policy. Then I start on taxation of employment income. Yep. Any question? Anyone with a question? You have the notes in your WhatsApp. Please, if you want to print a hard copy, you can do that. Some people just like me, I cannot read online. I have to have a hard copy, do anything you want, and please take time to revise. Asanteni sana. Enjoy the rest of the evening. Thank you very much.